It's Brian Preston, the money guy.
Only in America can we turn something positive like refinancing to get lower rates as it actually becomes a dangerous financial game for you. So let's jump into these. But first of all, it can actually be expensive.
Yeah, I was surprised by this. And I don't know if it was you or full-time equivalent Daniel that found this, but the average closing cost nationally is almost $5,000. So to close on a new refinance could cost as much as $5,000. That's expensive. That's not a small amount of money.
And it ranges from 2 to 5%. You're like, well, that's a huge range. Why would it be such a broad range between 2% or 5% on closing costs? The reason is, realize every time you refinance, your local government has recording fees, has state stamps. They have all these, they got their hand in your cookie jar. You have title insurance. You have all these things. So depending upon how your state looks at mortgages, taxes mortgages, you can see a big variance in what the closing cost is in your state.
The other big risk, Brian, and you said this kind of earlier on, and we'll kind of revisit, is that you never actually own the property if all you ever do is refinance. If you keep recasting, it makes it real hard to actually ever build equity in that home and actually own the piece of earth that your house sits on.
You create a carousel of resetting amortization tables. So your 30-year mortgage could very easily turn into a 45-year mortgage. And I think those are the risks you run. And then we put this part in there because this is where it can get dangerous with refinancing also, is you can actually cost you more money over the long term, even with a lower interest rate. And what do we mean by that is, look, you're extending the term. I talked about that with the carousel of amortization rates resetting, the tables resetting. But you also, every time you refinance, a lot of times your mortgage lender will say, okay, you either can take a premium on the interest rate or you can just roll the cost in. And a lot of people will say, well, just roll the cost in. It'll be okay. So you're actually increasing the amount you're financing. And then we've already talked about this as well. A lot of people take cash out when they refinance as well. So all those things in combination are actually dangers because you might not actually be working towards owning your house.
So we thought in true money guy fashion, perhaps it would make sense to look at a case study, right? Just kind of walk through an example of how most people go about refinancing. So we said, all right, let's assume that you have a house that you bought 10 years ago. So you have now been in the house for 10 of your 30 years. Let's assume that you still owe $100,000 on the outstanding mortgage. Your current interest rate on your mortgage is 5%, and you recognize that rates are low, and so you want to refinance to 1%. So you're going to save 1% on the mortgage rate. And let's just assume that the cost to refinance this house is about 2% of the loan amount, or $2,000.
Sure.
So, okay, let's talk about the original loan first. If you look at an amortization schedule, and basically that just shows a list of all of the payments, so if it's a 30-year mortgage, there are going to be 360 total payments. You have your payment, and every payment is composed of two pieces. There's an interest component, and there's a principal component.
Right.
And the way that amortizing loans work is you pay more interest early on, and then it slowly decreases through time. You pay very little principal early on, and then it increases through time. That's the way that the payment changes. So if you find yourself in this situation after 10 years, you're looking at month 121. You've been in there in 10 months. If you were to just stay in your current mortgage, you would continue to pay $660 a month.
Right.
That's your total monthly payment. So what most folks say is, okay, I want to do this new mortgage. I'm going to go refinance. I'm going to go from 5% down to 4%, and I'm going to do a new 30-year mortgage. Well, the great news is your payment actually decreases. You go from $660 a month down to $477.
More money in your pocket.
And not only that, because the interest rate went from 5% down to 4%, you're paying less in interest. You went from $416 in interest starting in the first month to only $333 in interest.
Before you hit the button, I already see something that gives me a little bit of a red flag. Look at the principal on the chart. Is old amortization, it's $243 of your $660 is going towards principal. Look at the new amortization table. I see principal, yes, interest is lower, but principal is only $144. That's almost $100 a month didn't go to principal.
That's right.
What happened?
Well, it's that part that you took off, that part that you're saving some interest, but you're also resetting the principal. So what actually happens with this loan is as you move through time, rather than having your house paid off in 360 months or 3 years, it actually took you 480 months or 40 years to pay off this home loan.
Wow, this is what I love about math, is because we have shown how you can take something very positive in the fact that you saved if you take an interest rate from 5% to 4%. Guys, that's a huge dramatic drop.
Yep.
You have essentially cut that rate by a fifth, which is a great cost savings measure. But somehow, and I know you're going to show this, we're going to figure out how we can pay more interest as well as take longer to pay off. Put that into numbers.
So here's the rest of the story. If you compare what you would have done originally versus where you were after you refinanced, you actually paid an additional $13,480 in interest, and it actually took you 10 extra years to own your home. So I would argue in this case, refinancing was not an advantageous strategy.
Yeah, it was done the wrong way. By the way, we have all the components here for this to be an actual happy ending and a good story. And we're going to try to show you how you turn that frown upside down so you do refinancing the right way. Before we kind of move on to that, though, I do want to talk about, this is something we have done quite a few shows on this, and this is one more angle that hit me the other night on should you do a 15-year versus a 30-year mortgage.
Because I know that if you've listened to, there's a lot of financial prognosticators out there that will just say, hey, no matter what, 15-year, 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 because there are some positives to it.
Yep.
But I worry that perhaps if you're so dogmatic and that's the only option you ever put out there, perhaps you're missing a bigger picture.
So let's give a few background context things first. I get it. When you go read books, like Chris Hogan has a great book, Everyday Millionaires, he shows that the average millionaire pays their house off in 10 years.
Yep.
You see that, that's a headline, and you're like, wow. So a 15-year mortgage is going to be probably what I need to do. I need to get out of debt as fast as possible. If you go read the detail or go listen to interviews of what Chris Hogan has talked about, he has shared that was not this person's first house. This was typically, the millionaire realizes, in their 40s or 50s. So this is probably their second or even third house. And yes, that is probably, I resemble a lot of that. And it is true. I will have my current house paid off within 10 years.
But this is not your first house.
Exactly. Because realize there's a lot of 25-year-olds, there's a lot of 30-year-olds, there's a lot of 35-year-olds that are watching this show. And you're being financially shamed in the fact that because you have so many talking heads, they'll say, this is the way you should do mortgages. You should do 20% down and finance them over 15 years. And you're seeing that and you're like, I live, and the cost of living is going up in my community. The cost of housing is going up. I feel like I'm on a treadmill where I can never catch up. And you know who can put down 20% on a 15-year mortgage? Rich people.
That's right.
And we're trying to get you to rich people status, but a lot of us don't start at rich people status. We have to kind of build the blocks to get there. So I want to kind of give one more reason why I think you can give yourself a little more breathing room without disrespecting how much you should spend on housing to the rest of your financial life. So realize, money guy rule that we talk about, Bo. Housing should be 25% of your gross income.
That's your top line. You can't go over that. If you go over that, perhaps you're buying more house than you can afford.
So how you spend that 25%, we're going to give you a lot of flexibility and freedom. And we've confessed this before, and I know we take a little flack, but I like to be very transparent with you guys. My first house, I put down 5%. Bo's first house?
3.5%.
So, and we went around and interviewed a lot of our staff, and I think only 2 of our employees put down 20% on their first house. I think it was Carter.
Yep.
It might only be one. It might have been Eric. But there was only 2 employees, because even Carol surprised me, because she is Mrs. CPA, super conservative, great with her money. She even confessed she was just like me. She didn't put down a full 20%. And we get it. When you're young and you're trying to do all the things you're trying to do financially with the kids, the family, the job, saving for retirement, life is kicking you in the rear end. Your wallet is just not gushing with overflow. So you're trying to make sure every dollar has a purpose and you're doing it. So that's why I want to give you that breathing room to be real with you, so I don't just look like a successful guy that's now shaming you because you're not putting down 20% and doing a 15-year mortgage. Because also think about every house decision you make, you got to raise the kids there. So if you're raising the kids, let's talk about if you only have a certain pot of money, it's at 25% of income. Let's look at some of the realities of how that actually plays out too.
Yeah, so again, in true money guy fashion, why not let's do another case study. So let's assume that you have a family that in the household they make $100,000 a year. We know that housing costs can only go up to 25% of your gross income. So that's $2,083 a month is what your housing costs can be. But we also know that when you buy a house, there are other things that come along with it.
It's not just principal and interest.
That's exactly right. They're going to spend about $600 a month on utilities, taxes, and insurance. So what that really means is when they look at their mortgage payment, that leaves about $1,483 a month that they can spend. So the question then becomes, if $1,483 a month is what I can spend, how much house can I afford? How much house should I buy with that?
So let's look at this, because I thought this was a very important thing. In America right now, we know that the average size of a house in America is between 2,600 to 2,800 square feet.
Yep.
And we also know now people in New York, people in California are going to laugh at this next number I tell you, because I just had to choose a number because it depends upon where you build a house or where you buy a house. Cost per square foot, I just landed on $130 a square foot. Now, even here in Nashville, we're laughing about that number because that seems super low. But in other parts of the country like Georgia, where we came from, you could buy a house for $100 a square foot. So I just landed on $130. So that way, I know I'm going to get laughed at by the coast. I'm going to get laughed at places like in Nashville. But it at least gives us a conversation point because it's low on purpose to be conservative. So if we know housing is $130 a square foot, how much house can you afford to buy if you know what that $1,400 a month housing payment can buy? So
here's what we figured out. If you're looking at a 15-year mortgage, you can afford a mortgage of $207,000, and at $130 a square foot, again, this is assuming after a 10% down payment, you can buy a house that has about 1,769 square feet. And I think you even had the number, Brian. This isn't a house that's equivalent to $230,000.
Exactly right.
So, okay, that is an idea. So for a young family starting out, 15-year mortgage, $230,000 house, 1,769 square feet. Without changing your cash flow, without spending more money, without having more cash, without going outside of your 25% realm, we said, well, what if instead of doing a 15-year mortgage, we decided to do a 30-year mortgage? How much house could we afford on our $1,483 a month mortgage payment?
Wow, look at that. That's a dramatic difference. Now you can afford a $367,000 house, probably around 2,800 square feet. So that, you know, the kids, you get enough house that it's not so big that it's going to be a mess to maintain, but it's big enough that you don't feel like every time you walk you're stepping on a Lego and tripping and hurting yourself. I mean, I think that this is a big part. And here's something that I like to always close with an exclamation point on this issue. A 30-year mortgage can very easily, especially when you're at interest rates as low as we currently are, a 30-year mortgage can actually be a 5-year mortgage. A 30-year mortgage can be a 10-year mortgage. It can be a 15-year mortgage. It can be a 20-year mortgage. They don't have prepayment penalties. So all you have to do, you have maximum flexibility that all you have to do is pull out your nerdy financial calculator, change your maturity date that you want to have the loan paid off, and start increasing your monthly payment. Guess what? Your 30-year mortgage magically, just like a transformer, has converted itself into a 10 or 15-year mortgage. Now reverse that. You go ahead and you do the 15-year mortgage. And you look at it, and maybe you decide, because I'll tell you my personal story. 15-year mortgage. I learned, remember, wisdom is created through experience. Did a 15-year mortgage on my second home. So proud of that. It was at 4 3/4, which was a steal on a 15-year mortgage at the time. But then we decided we were going to be moving. All of a sudden, I'm kind of regretting that 15-year mortgage because I knew that there was a period, especially when moving to Tennessee, I might have 2 houses for a little period of time. And believe me, having the squeeze of a 15-year mortgage then plus a new 30-year mortgage, it would have been a lot better if this was a 30-year mortgage and this was a 30-year mortgage so that I could have the flexibility. The same thing happens to you guys. When you do a 15-year mortgage, can it become a 20-year mortgage, Bo?
Nope.
Can it become a 25-year mortgage?
Not without refinancing it.
It sure can't become a 30-year mortgage.
That's right.
And I found that out. So if you want maximum flexibility, I will tell you there's nothing wrong with still having the intention of paying your mortgage off in 15 years, but doing a 30-year mortgage because there's no prepayment penalty. Go ahead, knock it out of the park, get yourself the flexibility. It also allows you, because here's the other great thing I like about Money Guy family members. We all start somewhere.
Yeah.
I mean, my first salary right out of college was $28,000 a year. Can't afford a lot of house at $28,000 a year. But the good news is just like a lot of you guys, you're on we start at the bottom, but now we're moving up to here. So your income is going like this. Do the mortgage financing so that you have maximum flexibility so that when your pay raises come, you will have the flexibility. You can always accelerate those payments.
And Brian, true or false? You're going to pay off your current house over 30 years.
No way.
No way. I'm
not on a 30-year mortgage, though.
But I've got the flexibility. And that's the big thing. And even if you're someone, please don't send us hate mail telling us why the 15-year mortgage is the most wonderful thing you've ever done. That's great. If that fits into your personal financial circumstance, wonderful. We're just saying you don't have to be so dogmatic about that's the only way to do it. And if you're young, it's okay to give yourself some grace.
Yeah, I just wanted maximum flexibility. I wanted to have the financial toolbox to where I get to choose how to manage the money, that financial order of operations. If I need this dollar from this dollar bill in my army of dollar bills to go here versus here, I, as the field general who knows exactly real time what's going on, I know where to move and position those dollars in real time.